Welcome back. Our next guest is a veteran portfolio manager who challenges one of the most widely held beliefs in investing: portfolio diversification. He says investors should be wary of owning too many stocks in their portfolios. Let's bring in Jason Del Vicario. He's portfolio manager at Hillside Wealth Management at IA Private Wealth. Jason, thanks a lot for joining us. This sounds like heresy compared to what we hear very, very often on this channel from peers of yours in the industry. Why do you think diversification, which is often defined as something between 20 and 30 stocks in a portfolio, is too many stocks?
Well, why diversification, as Warren Buffett says, is for those who don't know what they're doing. And about 20 years, I went down the rabbit hole of investigating people that had put up very, very strong track records over decades. And one of the commonalities amongst these very, very successful managers was that they held a concentrated portfolio. And then if you shift gears and head over to the academic research, there's a number of studies on the notion of the ideal number of holdings in a diversified portfolio. And the academic studies land anywhere from about 15 to 25. So, you know, that the evidence is there, and we certainly abide by this concentrated notion.
That it surely dials up risk, correct? I mean, what do investors need to understand about their risk tolerance, their appetite for risk, and the number of stocks in their portfolio?
Sure. So no, it doesn't necessarily dial up risk. However, with the caveat being that if you held 15 pharmaceutical stocks or 15 stocks in the same industry, then of course you would be exposed to more risk. So these 15 to 25 names that you might want to hold in your portfolio should be not necessarily in the same industry. What we can understand...
Yeah, but no credible investing professional would suggest that somebody owned 15 pharmaceutical stocks in their portfolio. The idea behind diversification is that not only do you diversify the number of stocks you own, but you also diversify the number of sectors that you're exposed to.
Correct, yeah, and so it's worth noting that. Now, we can all appreciate that if you have 3 stocks in a portfolio, you're more diversified than 2, and if you have 5 stocks, you're more diversified than 4. What happens is at about the 20th position in a portfolio, the marginal level of diversification, meaning the extra amount of diversification you get by adding the 21st, the 30th, the 50th, or the 100th position in a portfolio, starts to drop and drop dramatically. By the 20th position in a portfolio, 96% of the diversification benefit is achieved. You only get an extra 4% of diversification benefit between the 20th and 200th position in a portfolio. And I think this is actually very good news for investors.
How many stocks do you tend to hold in client portfolios on behalf of clients?
Right. So right now at Hillside, our all equity portfolio owns 28 businesses. The top 10 businesses that we own comprise 70% of our equity, and the top 3 positions comprise 32%. So we certainly walk the walk here on the diversification aspect.
Okay, let's talk about some individual holdings that are in your client portfolios. Your top 3 holdings. Number 1 is Constellation Software, a favorite among many Canadian investors, and a stock that has rewarded investors who have held it for the longer term.
Certainly, yes. So Constellation Software is our largest position at 14% of our equity weight. I've mentioned it a number of times on BNN. It's a fabulous company. They are perhaps the best capital allocators on the planet. And they've done 2 spin-offs recently, just to give you a sense of how this is built to a 14% position. And we made the decision to sell Topicus and Lumine, which were 2 of their spin-offs, and buy and just hold the Constellation Software shares. So we have benefited from them issuing stock dividends, which we've then turned into regular equity weight of Constellation Software. The other thing I'll note is that when you have a compounder on the line, you want to keep it and resist the urge to do something silly, which often is selling. So we do have limits on our position sizing. The upper limit for us on Constellation, which is a large conviction position for us, would be 20%. So you know, we won't let it go beyond that, but we're certainly happy to let it run to its current weight of 14%.
Okay, and number 2 is Meta, the Facebook company.
Right. So Meta is a medium conviction position for us, which means it comprises, when we bought it, 5% of our equity weight. We will allow our positions to go to 2.5 times our conviction level. So 2.5 times 5% is 12.5%. And Meta currently occupies 11% of our equity. It certainly had a massive run this year, which we benefited from, and we would start to trim it at 12.5%. So we're getting close to that level as well.
Okay.